Hi, everyone. My name is Josh Nelson, and I'm joined by Jeremy Bush today. We are certified financial planners and the financial advisors, financial planners, whatever you want to call us, but we're at Keystone Financial Services. And we're going to be talking about the forecast today, which we always do at the beginning of each year. So welcome, Jeremy.
Thank you, sir. Good to be here and good to go through some good data here.
Yeah, for
Absolutely.
sure. Yeah, and as any forecast, just like if you're talking to the weatherman, the weatherwoman, right? I mean, either way, it's a forecast, right? So there are a lot of things that have happened already, even up until now,
Absolutely.
right, mid-February. So we'll update some of those things as we go, even though we created these slides here about a month ago. Certainly a lot of things that have happened since then, some good, some bad, but really this is just a forecast and the reality of kind of our opinions and what we're seeing and what we're hearing from the experts that are out there.
Absolutely. And I think a lot of this stuff you'll actually see has played out. So
Yep,
we did a pretty good job on some of this.
absolutely. All right, before we get going, we are, again, Keystone Financial Services. We are a fee-only wealth management firm. We are a fiduciary. There's different terms that we get called, most of them good, right? But we are a fiduciary, and that is different. Not all advisors are fiduciaries, and oftentimes you do find that some of the expenses that you might pay with a non-fee only advisor could actually be really, really high. You may not know it. So it's important to look at what you're actually paying, what you're getting for that. And the slide that we're showing right now, making the complex simple, really illustrates that with most investment advisors or financial advisors, really what you're getting, what you're paying for is investment advice. And of course, that's important, right? That's certainly something that we're delivering, but also there are a lot of areas that impact your financial life, estate planning, tax planning, two really big ones. But of course, a lot of other decisions that come up along the way. Could be planning issues around people's college education funding or optimizing for their tax situation, planning for their employee benefits or their equity awards at work, even trying to decide what Social Security age do I start drawing at? Do I withhold when I start doing Social Security, or do I pay the taxes quarterly? And there's all kinds of different things that come up. And of course, that's why it's fun for us because every client situation is different. So making the complex simple. We have this piece, by the way, we can email this to you. It's also on the website, but it's a great illustration of what we actually do, which is kind of everything when it comes to people's financial lives. These are disclosures.
Yeah. Always important to put this up here for compliance sake. But the important thing to remember is all this stuff is pretty much just our opinion, right? So not meant to make any recommendations to anybody specifically, largely because everybody's situation is specific to them.
Yep, and as always, there are no guarantees, right? So everything we
Absolutely.
talked about today, yeah, just our opinions, but we do pay a lot of attention to the experts, and the experts are
Mhm.
also not always right. In fact, oftentimes they're wrong, right? But just like the weather forecast, right? They're paid to give an opinion, and they're analyzing that data and they give it. So it's always good to take that with a grain of salt as well, no matter who it is that you're listening to as far as an expert. So today we're going to talk about, as always, our forecast presentation and also our halftime presentation, which happens to be halfway through the year, usually in July. Halftime presentation, we go through where we've been, where we are, where we may be going, and we will also do that today. So first thing, this was a good year. This last year and the last couple of years actually were really good years for the stock market. If you were invested, basically just in a broad basket of stocks like the S&P 500, and of course, we would recommend that you diversify further than that. But if you were invested in a broad basket of stocks, you probably did quite well. Up 23% or so in 2024, up 26% in 2023. We don't know if that's going to repeat necessarily in 2025, but it has been a good run. In fact, the best two-year run since 1998. So that was great. Certainly, a lot of that was driven by technology stocks, the Mag 7. Many of you have heard that term. Which would be Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, and Tesla. And those stocks do trade out from time to time. Sometimes stocks fall out of favor, but that was about 33% of the market gain. Actually, 33% of the market capitalization is concentrated in those 7 stocks. So they're big. In other words, those companies are big, all $1 trillion plus, I believe, at this point. As far as value. So they do swing the market, and a good reason for diversification, not to just have all your money in the S&P 500. Even if you thought you were diversified by just owning that, that's a lot of concentration just in those 7 stocks.
It absolutely is. And an important part of this too is that, yeah, for 2024, these Magnificent Seven, they kind of led the way in the first quarter of it. But then it is also important to realize that after that first quarter, the rest of the S&P really kind of started catching up to them, right?
Absolutely.
And so, yes, they started it out, and yes, they're big players in this, but the S&P 500 overall throughout probably the last 3 quarters of 2024 really did come on strong. And so, driven by those earnings, of course, which is really ultimately what drives the market.
Yeah, yeah, surprisingly, a really boring, probably the boringest sector of the S&P 500 utilities, actually are one of the best sectors, I think, in Q3 this last year. So
Mhm.
much of that was driven by demand for energy, right? Of course, but by AI, but still, having all your money just in those 7 stocks would not be a great idea. That would be really, really high risk. So that's been good. The economy obviously did well, too. We have not been in a recession, thankfully. And again, here a couple of years ago, most experts, we were thinking it wasn't going to happen, but most experts were saying we were going into a recession, things were going to go into this big downturn, and it never really materialized. We never actually went into a recession other than back in the pandemic in 2020. But 2022, 2023, all the dire predictions didn't really come to fruition. So that would have been a really bad time to be out of the market. The economy continued to chug along, certainly at 2.9%, which is right about the historical average. You look over the last 100 years or so, that's about what our economy has grown at least in the US. You look at other markets out there, international equities continue to underperform. Many kind of developed, we would call developed markets would be like Western Europe, Canada, Japan, Australia, those sorts of countries. Those economies continue to underperform the US. So the US, even though we're not perfect by any means, continued to outperform the rest of the world, other than some emerging markets, which obviously have a different characteristic, different level of risk. So one thing to note there too is that it's always good to have international diversification, even though if you own them, you maybe have noticed your international stocks haven't done as well as maybe your US stocks. But historically, it's good to have both. It's good to have that diversification in your portfolio. And then finally, crypto, obviously that continues to be grabbing headlines, right, and has become a lot larger part of the market. There's a lot of risk there, a lot of volatility. Bitcoin got up to about 108,000 in December and now has gone way down to about 90,000 or so. So we do see some pretty dramatic swings, even though that asset class probably is not going away. Certainly, it's going to be there, but we don't expect that it's going to get any less volatile. There's just a lot of turbulence there.
Yeah, which I think is the thing. I mean, even with the deployment of ETFs, so pretty much anybody can invest in cryptocurrency now. It's still incredibly volatile. And we were at a meeting this summer, right? And the actual people selling the ETFs for crypto were like, "Hey, we're not seeing this as something that you should just jump all into," right? They say part of a portfolio is maybe 1 to 3% of crypto, right? So yeah, it could be a future diversifier, but just understand that it's going to be very volatile, and that's not going to go away anytime soon.
Yeah, exactly. And just because extreme volatility, just like extreme turbulence, right, that you might have on a flight, crypto is about as far out there as you get. So only people who have very high risk tolerance should be looking at that, at least at this point, as an asset class that they should be including in their portfolio. Again, it's always good to have lots of eggs, lots of baskets, lots of eggs, baskets, right?
Lots of eggs and baskets,
Lots of,
very well diversified.
Right, of course. We use that metaphor that, we can manage all your stuff on one farm, but we don't recommend that you put it all in one basket. That would
Absolutely.
that would not be a good option. So in valuations overall in the stock market, we touched on that before, just with the Mag 7, that does equal a pretty good chunk, about a third of the overall S&P 500. Certainly there are always parts of the market that are in a bubble territory. Sometimes that comes up in the conversations that we have. People are worried about, this being like the late 90s where the entire stock market just got way overvalued, and then we saw a terrible bear market and the bubble burst and so forth after Y2K. Not that we can't guarantee that that's where we are right now, but again, if you take out the Mag 7, and especially even just take out the tech sector, there are a lot of parts of the market that are not in bubble territory. They don't look particularly expensive. So again, reason why you want to stay very diversified and not too concentrated in one area. While valuations are elevated right now, it's not something that we're considering a bubble. We usually will measure that based off of price to earnings ratio. Really, a stock is just worth its earnings or its future earnings, right? That's why earnings reports and so forth are so important. because it's really the prediction of what earnings are going to be for that company in the future. That's what the current stock price is reflecting.
And that's really what the market's trying to do, right? Is
Right.
look out about 6 months and say,
Mhm.
hey, where do we think this is gonna be?
Yeah.
The thing that throws volatility in there is when there's uncertainty,
Yep, which there always
which
is.
there's
of
always
course.
uncertainty, sometimes more than others.
Yeah, just like a flight. I mean, you could have the best pilot in the world, right? And it doesn't matter, right? If there's unsettled air, they can try to do some stuff, right, to try to get
Mhm.
around it. But it's something that you just kind of have to experience when you're on a flight, is that a lot of turbulence is unexpected, and something that is just part of being an investor. That's really the key, though, is being a long-term investor means that although that's not comfortable, you don't react to it. Right? You may rebalance your portfolio, may make some adjustments along the way, but dramatic, moves in and out of the market, nobody's been able to do that consistently over time. That's just not a sound strategy for investing.
Absolutely. Yep. So where do we find ourselves right now? So obviously there's always some factors, influencing the market. Started out the year January to some initial declines across the board,
Yep.
right? But I would say that's fairly typical, honestly, in a
Yeah, and if
January.
you remember that, by the way, I
Right?
mean, really, and we don't even go as
Yeah.
preparing this. Most volatility, just like most turbulence, people don't remember it. It's something that's not comfortable at the time, but
Mhm.
almost all the downturns that we've had, people, when we remind them of certain ones, like the financial crisis, right, or the Y2K or 9/11, yeah, they might remember those, but most of the time the turbulence just happens and we move on.
Absolutely.
Yeah.
And overall since then, and at the time that we're doing this right now, S&P 500 is up about 2.5 to 2.9% right now.
Right.
So not, yeah, still on the positive, absolutely, but we're definitely seeing some more volatility this year. Strong economic reports. So obviously high inflation and interest rates are on everybody's mind. The Fed came out, I guess that was last week now,
Right.
and said, hey, we're going to do a pause on interest rate reductions at this point. Right. So they're still definitely kind of fighting that fight. Right. But we alluded to it earlier that when they started doing this, I think the general consensus was that they're going to put us into a recession. And we kind of all scoffed at the whole soft landing
Usually that's
thing,
what happens. Usually the Fed tightens too much and there's a recession. Historically, that's a pattern.
Absolutely.
It didn't hold this time.
And it's really hard to do, but we should probably give them a little bit of credit in arrears because
Yeah.
they've actually done a pretty good job at it, to tell you the truth. And then of course, this one comes up in meetings all the time. And politics, yes, short-term politics can definitely drive some volatility, especially when we're talking about tariffs and taxes. They call Trump the disruptor in chief for a purpose, right? He likes to throw wrenches out there.
Yeah, I
And
think he would accept that title.
I think absolutely. I think he loves it.
Yeah.
But no matter where you sit on the side of the aisle politically, right? Politics are always just kind of one of those realities. And again, the market's just trying to figure out which direction to point. And so when it doesn't know, it just adds volatility in there.
Yeah, the market and money, just in general, money is not really political. Money just wants to make money. I mean, people, investors want to make money. And, we believe that it's really important to just know what season you're in, really to just know what environment that you're in. And to be expecting, if you've got a lot of uncertainty because of policy changes and so forth, and the market's kind of settling into that, right? With tariffs, probably are a new negotiating tool, right? And that's probably not going to stop anytime soon. And taxes are another one. Interest rates are one thing, but taxes are another. And this is a big year. At the end of this year, the Tax Cuts and Jobs Act from 2017, many of the provisions from that tax bill, those tax reductions actually expire. So a lot of uncertainty coming this year. More than likely, it's going to take all year until you see legislation pass, if it does, right? We don't know that. And we have no idea what that'll look like. So that's certainly a thing at any given moment, whether it's crypto or bonds or stocks, any kind of an investment at any given moment in the market, those assets, right? We kind of think of them like they're human, right? Something like that. But everybody's trying to figure out, what does this mean? What does this mean? What does this mean? So when you're seeing the market jump up and down, even within a day, that's basically just kind of collectively everybody trying to figure out, the large scale, kind of what does this mean and what does this mean for the future as far as money.
Yeah, absolutely. So then, of course, the economic indicators that we all like to take a look at. So employment data, this is kind of one of those moving targets, right? But really mixed job reports as it's coming out. But overall, we're still very low on unemployment.
Historically, very low.
Yep, historically. So not too bad with that. Of course, that can change, right? Depending on what's going on currently right now. There's a big federal workforce reduction
Right.
that's pretty much happening. So
Yeah.
will that play into it?
It's on pause temporarily, but
Probably,
yeah, again, another
right?
uncertainty, right? I would say that's a good theme for this year is just get used to uncertainty, get used to turbulence.
Absolutely. And then of course we add in GDP or gross domestic product, right? So GDP kind of at that annual rate of about 3.1 or so, kind of projecting a little more of the same, right? And then when we look at it globally and whatnot as well. So not a lot of change there really from what we're seeing, but kind of the regular norm. The thing that really kind of throws it in, and I think this goes to, again, a little bit of politics, new administration, but that consumer confidence number, right? And really, leading up to, I would say, kind of COVID in 2020, consumer confidence was really at an all-time high. And if you look back far enough, we were just coming off literally the longest bull market that we'd ever seen. Right, in the U.S. economy.
Expansion, absolutely.
Absolutely. And then that kind of threw a wrench into it. And I think it's really the market, the consumer confidence has never gotten back to that pre-COVID era. Right. And it's had its ups and downs, and it has a lot of volatility in and of itself.
It was a new normal. I mean, clearly, right, in lots of ways, right, with shutting down and kids that doing school from home and work from home. There were huge disruptions to supply chains. Remember toilet paper, right? Remember when toilet paper was being rationed?
I heard a thing today that eggs are the new toilet paper.
It seems like that.
Right?
Yeah, absolutely. So consumer confidence is a big thing. Even just you think about day to day, 70% of the economy is just us spending money on stuff, right? And if you go to the airport, I mean, the planes are full. You go to a concert, all the seats are full. People are doing stuff, right? And largely that is because people have jobs. If they want jobs, and there's always some, up and down, right? You never get to a 0% unemployment rate. There's always people kind of moving around, and some industry is always cutting back, right, and making adjustments. But historically, we're at very, very low unemployment rates.
Yeah, absolutely. And then we kind of alluded to this earlier. So Federal Reserve policy, really kind of taking that sit back and see approach right now. Things have moved down. Now, the important thing to remember is, especially when we're talking interest rates and when we're talking inflation, is that not every sector, right, feels the cuts or drops as fast as every other sector. So there's always going to be parts of inflation, I think, that kind of stick around while other parts are going down. That's why the Fed has multiple measures that they measure by, right? And so kind of the key numbers here, though, are that, yes, inflation in general is coming down. Our grocery prices and fuel prices still high. Absolutely. But still, their policy is they're very closely monitoring everything. Obviously, they have a new administration to work with as well, which presents them with additional challenges. But overall, they've been doing a pretty darn good job so far. And we haven't hit that recession that's been talked about for at least the last 2 years.
That's a good point too. On their inflation measures really are kind of a basket of goods and services across the economy. And although none of those are perfect, right? Because sometimes they come out with a 3% number, and then we'll hear people say, well, that's not what I see when I go to the grocery store. Right?
Absolutely.
And that's true, right? I mean, there's always some factor like eggs right now. I think it's avian flu, right? It has nothing to do with a pandemic or probably government policy or anything like that. It was disease, right? They had to kill a lot of chickens, right? So
absolutely.
There's a lot less eggs out there. So economics 101, right?
Supply and demand, right?
Demand.
Absolutely.
Yeah, and certainly that has an impact on people. But inflation. One thing about inflation too to recognize is that when we talk about inflation coming down, really the key on inflation is that inflation never really goes backwards. So if you look back to the Great Depression, that was one of the few times that prices actually dropped dramatically, and we don't want that. You don't want a depression,
Yeah.
right? So it's just the pace of increase has slowed way down.
Absolutely. Yeah, and then really kind of the overall global economic context of this. So when we look at currency markets, the US dollar is very, very strong right now.
Has been. Yeah.
So that, yeah, and that has pros and cons, honestly, when we look at it for various things, strong service sectors, et cetera. But obviously a lot of the Fed rate cut kind of cuts into this as well. But then, of course, international trade. And so this is not something that has happened overnight either, right? So our US trade deficit, which is basically, if you think about it, is just the measure of what are we exporting versus what are we importing, right? And so for this one specifically, this is just China and Hong Kong, right? And so you can kind of see the red line on there is kind of the average moving average of those times. But it's quite a bit, right? We as a country tend to import a lot more goods from other countries, right? Now the key is the things that we are exporting are probably those higher end things, right? Like computer chips, et cetera, right? The things that we're importing are kind of your everyday stuff that maybe you're buying at Walmart, things of that nature, right? But the overall aspect of it is, yes, the current trade deficit is upwards around 36 trillion, is that?
Yeah.
Yeah.
Yeah, it's high.
So it's up there, and it's never been that high, but still, as the strong dollar, right, kind of plays into that as well. So,
Yeah.
but that's been something in development over many, 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 many years.
Yeah, yeah, and you see that in your investments too. When you see it, just looking at currency alone, the strong dollar is one of the reasons why, if you have a diversified portfolio, you've seen your U.S. investments do better than your foreign investments. But you'll see the opposite too, right? Things go back and forth, and when the dollar weakens compared to other currencies in the world, you'll definitely see that. All of a sudden, it looks like, wow, my international investments are doing so great. It's not just because the stock prices have gone up; it's also because of the currency changes, because you're probably buying it in the dollar, right? We're buying even foreign investments, we're buying those with dollars. So that's important to have that currency diversification as well.
Absolutely. So where are we headed?
Yeah, so slower economic growth. That we are expecting the GDP is going to moderate. Again, we've been kind of running about 3%. That might get closer to 2%. And inflation as a trend, we think it's going to come down over the next few years, but probably not as fast as we originally had thought. I think the Fed right now is pretty, and this is actually a vote of confidence in a way to the economy. The Fed is actually saying, hey, we're pausing on interest rate decreases. The last thing they want, since they killed the dragon, we think, right? They killed the inflation dragon of those really high numbers we were seeing a couple of years. Last thing they want is for that to bounce back, and that's kind of what happened in the early 80s. Actually, is that they let off of the they kind of hit the brake and they let off too early, and then inflation came roaring back. And those of you who had mortgages or CDs or anything like that back in the late 70s, early 80s, you probably remember that. A lot of up and down inside there. So the fact that the economy still continues to grow, even with higher than what we're used to, right? From a historical context, a 7% mortgage rate is not bad. Again, several of you probably could go back. I think my first mortgage in the late 90s was 8.75. But a lot of you had double-digit interest rates on your mortgages and other loans and things. So from a historical perspective, it's not terrible, but certainly it's very high compared to what we're used to in the last few decades.
Absolutely. I think we've gotten a little bit spoiled there with 2.5% and 3%.
Yeah,
for a while.
Yeah, we could unpack that for the audience as far as post 9/11 and Fed policy and the financial crisis and rates going to zero and quantitative easing. That kind of gets beyond the scope of what we'll unpack right now. But there were a lot of reasons there where interest rates were very, very low, which depending on who you were, that could have been good or bad. If you were borrowing money, it was great, right? Mortgage rates were very, very low. Many of you probably have 2 point something or 3 point something% mortgages, even if you had caught it right at the bottom. Those days are done, I think. I mean, for maybe forever. We may never see those interest rates again. So again, adjusting to the environment, I think that's important, is just recognizing the environment that you're in. And again, that's not a political thing. It's although politics play into it, certainly. Policy makes a difference. And smart investors, smart people that are smart with their money just kind of recognize the reality, right, of what is, and then adjust to that, adjust their portfolio accordingly.
Absolutely. But yeah, and then like we said, we've definitely seen a trend down. So obviously 21 and 22, we had a lot of inflation there, but since then it has definitely taken steps back. And again, not every sector, obviously, right? So grocery prices still feel high, energy prices still feel high. That's probably not going to go away anytime
It's
soon.
not, and yeah, some people will say that too, is when are prices gonna start coming down? Well, I don't know about, I wouldn't hold your breath, right? Inflation
Yep,
tends to be pretty sticky. You're
absolutely.
probably not, when you go out to eat, I mean, the prices that you see there probably are not coming down. There are
Mhm.
labor costs, things that restaurant owner has to deal with, and their own food prices being higher. Those food prices are coming down, so it is a new normal. Inflation as a trend does tend to be permanent. That's very rare that we actually see real deflation. Although there are certain products, I mean, you could say like, well, flat screen TVs, right, or something like that. Well, yeah, I mean, there are certain consumer electronics prices may come down, but as a trend, you don't tend to see prices actually drop as a whole, and really you don't want that. And that
Mhm.
means your economy is in really bad shape typically if you're seeing deflation. That's depression sort of thing.
Yeah, absolutely.
So where we may be headed again, unemployment, just to, again, maybe reverting back to the mean, but unemployment probably is going to tick up over the next few years. Although not dramatically, 4.5% is higher than we're at right now, but historically that's still very, very low. That means that most people that want a job have one, may not be the job they want. I mean, just to be, fair there, some people
Mhm.
may not be, and that's partly why you always see an unemployment rate, because people aren't always happy with what they're doing. They may end up moving on. There's always going to be some gap in time, right? Whether they get laid off or they leave on their own. Another thing that we need to keep in mind too here that makes a huge difference is just that the baby boom, which I just read, the oldest baby boomer is about to turn 80, actually. But you've got this generation that about 10,000 people a day for a lot of years now, about 10,000 people a day have been turning age 65. And for many people, if they haven't already retired by that point, oftentimes that is a trigger because
Mhm.
they're Medicare eligible. Sometimes they're kind of waiting for that age.
Absolutely.
So their health insurance costs will go down maybe, or certainly could be lower than if they went out on the open market and bought insurance. So knowing that you may have a lot of people leaving the workforce, we don't know that. Certainly my dad, I think he worked until he was in his late 70s, 77, 78, something like that. Still enjoyed it. Maybe we'll see more people doing that if they need to for their own finances, but that's a factor, certainly, as far as the available labor pool that will be there.
Absolutely.
Then interest rate reductions, again, this has probably changed even since we created the slide a month ago. I think it's even more likely that interest rates will stay where they are for longer. We probably are not going to see, if I had to bet money on it, I bet we won't see any rate reductions this year. And unless those inflation numbers really come down at some point during 2025, I think we're going to be kind of sitting at that 4.25% to 4.5% that we're at right now. Originally, when we created the slide, we were thinking maybe down to 4%. May not happen. And in fact, if there's really a spike in inflation, if things really take off for some reason, we might actually see rate increases.
Which is definitely possible. And things like tariffs or uncertainty in that measure that can
Yeah,
absolutely play into it,
yeah.
right? As certain sectors tick up and push it up. But yeah, the Fed's, as of right now, they're strongly signaling that we're just going to hold course for now and see what happens.
Yeah, and again, maybe that's a vote of confidence because they can see that the
Hmm.
economy can handle it. The economy continues to be okay, even with rates at their current levels. That being said, there's always a potential of a market correction. A market correction would be a 10% or more drop in the market. That happens pretty routinely, about once a year,
Hmm.
historically. About 20% drop or more would be considered a bear market. The good news is that about 80% of the time, corrections don't turn into bear markets, meaning that
Hmm.
you're flying along pretty smoothly, and all of a sudden there's some turbulence, and you last for a few minutes, and then you go back to sleep, right? But sometimes things get really bad, right? Violent turbulence, in other words, and that doesn't necessarily mean that the plane crashes. I don't know that planes crash because of turbulence, but it can get really uncomfortable,
Hmm.
for people, and certainly we see that at least once a decade. But a lot of times more often than that. Last one we've really seen was back in 2020 for the pandemic. We saw about a 30% plus drop in the stock market in the span of 3 weeks. So talk about an air pocket, right? As far as the plane dropping very quickly, and rightly so when you're talking about that much uncertainty, shutting down huge portions of the economy. So just know that that's always part of the ride.
Mhm.
Being a stock market investor, whatever level of stocks that you own in your portfolio or crypto or even bonds, just owning assets in general, even real estate. You know, we go back to the financial crisis. That was kind of ground zero, right? With banks and real estate, that was a really tough time. So just expect increased volatility for a variety of reasons. One of those is certainly tariffs, uncertainty there,
Mhm.
uncertainty around tax policy, uncertainty around interest rates. So there are a lot of kind of clouds out there, right, that look a little bit thunderstormy, and that could actually create some volatility this year and possibly a correction. It could be even as bad as a bear market, depending on how things get. But certainly there will be sectors that do better than others. In the stock market right now, it would be a really bad idea, as always, to put it all in one sector, to put it all in tech stocks or all in utilities or all in energy stocks. We always believe in diversification, but it's pretty likely that we're going to see some rotation. We've already seen some of that,
Mhm.
as Jeremy mentioned before, sectors that were underperforming tech before. We think financials, energy, consumer staples, those sectors are kind of primed right now. Healthcare, technology, industrials, certainly are a different story. The weighting of these things is important, and you'll get that by having a diversified portfolio, but those are adjustments that we make as well, really, as
Yeah.
we're looking at things.
And that's really where we kind of come in, always behind the scenes and whatnot, just kind of periodically rebalancing, listening to a lot of research and trying to take advantage of those opportunities
Yeah.
when they arise.
Yeah, absolutely. We're an independent firm, which is great for you, as a client, because we're just working for you. But we do have institutional access at Fidelity, Charles Schwab, other companies that give us some great insights as we're making those decisions. So, and finally, trade tensions. We talked about that before, but trade tensions certainly are a thing. Tariffs, that it's continued to get more protectionist over time versus 30 years ago. Things were trending towards very free trade. We've actually seen much more, not just in the U.S., but a lot more tariffs, a lot more kind of protectionist policies from a trade perspective. And then there's always geopolitical risk. There's
Mhm.
always wars, although it looks like right now a couple of those might get taken off the table if the war in Ukraine ends up winding down. It's possible.
Yeah.
And in Gaza, with Israel, hopefully that continues to wind down, but you never know if those things flare up. Even though there's some hope right now, there's always a hot spot in the world.
That's really well said. There's always a hot spot, and there will be another thing
Yeah.
that comes down the road,
Yeah.
right? But trade restrictions are just one of those geopolitical things that NATO countries can do, and without sending troops in,
Right.
because that's
Yeah,
kind of their
exactly.
first
Yeah,
go
trade
too,
war.
right?
Yeah.
Is
That's why it's called a
let's
trade
put
war.
some restrictions on you.
Right.
Yeah.
So, so a lot of uncertainty there, but again, there always has been, right? So,
Mhm.
just expect that that's part of being an investor. That's part of just being human in the world. Is you've got that headline risk of something happening, and sometimes it has a major impact on the economy, and sometimes it doesn't. And as always, for people who don't have a very high risk tolerance, especially if you're kind of headed towards retirement, you might be looking at fixed income, other assets to diversify your portfolio. We would exercise caution on the stock market, just from the perspective that if you've loaded up on stocks and maybe not rebalanced for a while, that's something you really should look at. And if you're not working with us, possibly partner with us to look at that with you. And this is the periodic table of investment returns. Every year, these kind of trade back and forth. Kind of looks like the periodic table of elements. But
Mhm.
if you have a diversified portfolio, it's going to be a much smoother ride than somebody who just puts it all in real estate or all in stocks or all in tech, all in crypto. If you do that, then you're going to get all the volatility too that comes with that asset class. And as you can see, if you were to spread it out across the kind of lanes of traffic here across the market, you'd be in a lot better place and still get to take advantage of those areas when they do well and minimize the losses on things that don't do well. Couple quick quotes to wrap up. Keith Lerner from Truist Advisory. This bull market is still intact. This pullback is just the cost of doing business, and those using this as a buying opportunity can see long-term gains. We kind of talked about that because when we prepared the slides, we had seen a pullback that's already forgotten at this point. But we do expect that stocks as a trend will continue to do well. That doesn't mean that there won't be corrections in the midst of that, but there are a lot of reasons to be optimistic about the global economy in the years ahead. From Goldman Sachs, we believe the U.S. stock market remains a cornerstone for growth, with an 80% chance of continued, remember what we said about forecasts, right? With an 80% chance of continued economic expansion, staying invested in 2025 will likely yield positive returns. And that's our belief as well. We think that this year actually is going to end up being a good year. You know, if you kind of wake up on December 31st, if you own stocks, will you probably be up? Probably. As much as the last couple of years, probably not. I mean, it would be great, you know, if that happened, but I think a lot more likely that we'll see average returns, which, you know, would be like high single digits, you know, maybe 10, 11, 12% in the overall stock market. I think most people could be happy with that.
Yeah, seems like a pretty average year, I think, is the general
We
consensus.
hope. Yeah, we'll see what happens. Again, kind of touching on making the complex simple. Obviously, the world is complex, especially the financial world is complex because the rules change, tax policy changes, the market constantly changes, and of course, your life changes. And as a team, it's our job really to be looking at all this stuff with you and applying it to your situation. Like, what does this actually mean for you? Based on when you're retiring, how long you're working, what you're contributing, and do you have a plan that has a really high likelihood of working out? You can't say the word guarantee, right? But we do like math, and we do like you know, playing with numbers and running scenarios and really stress testing just to see, hey, you know, are the principles that you know, people have followed over the decades that we follow, right? You know, for successful outcomes. You know, does your situation look like that, or are you off track someplace? And then we need to kind of help you figure out what are the choices for that. So our team is our greatest asset, as always. We thank you for your business. We thank you for any questions that you ask in advance, by the way. So just email either one of us. That's probably the easiest. Just Josh at keystonefinancial.com or Jeremy at keystonefinancial.com. You can also visit our website at keystonefinancial.com. And as always, we like to see you too. You know, we have a lot of virtual capabilities, Zoom and so forth. But we want to make sure that that you know we always enjoy getting together with you face to face as well. Otherwise, have a wonderful week. Appreciate your business. Thank you for the partnership, and God bless.
Take care. And we're done recording.
All right. Good. All right, we got it.